147%. That's how much silver gained in 2025. Gold delivered an extraordinary 67% return in the same period, and investors around the world celebrated. But silver didn't just beat gold, it obliterated it. And if you're still thinking of these two metals as interchangeable safe havens, as basically the same trade with different price points, I need you to listen very carefully to what I'm about to tell you, because in April of 2025, it took 107 ounces of silver to buy a single ounce of gold. Today, that ratio sits at 50 to 1. That's not normal market movement. That's a structural shift that signals the greatest wealth transfer between these two metals in modern history. And the forces driving this divergence aren't slowing down. They're accelerating. My name is Ryan, and for the past decade, I've been analyzing precious metals markets and the macroeconomic forces that most financial advisors won't explain to you. And what's happening right now with silver isn't just interesting. It's the asymmetric opportunity of this entire decade. If you want to understand where real money gets made in commodity markets, make sure to hit that subscribe button and give this video a thumbs up if what you're about to hear changes how you think about precious metals investing. Here's what we're going to cover. Three colliding forces have created what analysts are now calling the 2026 silver singularity. China just weaponized their silver supply in a way that makes their rare earth restrictions look tame. The global market is facing an 800 million ounce structural deficit that cannot be solved by simply mining more. And the Federal Reserve independence crisis that's pushing gold past $4,600 is creating a monetary panic that silver is uniquely positioned to exploit. By the end of this video, you'll understand why Bank of America is projecting silver could hit $309 per ounce, why the physical market has completely divorced from paper prices, and why the question isn't whether to own precious metals in 2026. It's whether you're positioned in the right one for the phase we're entering. But first, we need to understand what just happened, because most investors completely missed it. For decades, gold and silver moved together. They were the monetary metals, the safe havens. When uncertainty rose, both rose. When the dollar strengthened, both fell. The ratio between them fluctuated, sure, but it stayed within a predictable range. 60 to 1, 75 to 1. Sometimes it stretched to 80 or even 90 to 1 during extreme events, but it always reverted. That was the normal pattern, the historical relationship that traders built their strategies around. In April of 2025, that ratio hit 107 to 1. Silver was cheaper relative to gold than it had been in over 20 years, and conventional wisdom said this was temporary, an overextension that would snap back. Buy silver, wait for the reversion, profit. Simple ratio trade that precious metals investors had executed dozens of times before. Except something different happened this time. The ratio didn't just revert, it collapsed. From 17 to 1 down to 50 to 1 in 9 months. That's a 45-point compression in less than a year. And here's what that means in actual performance terms. While gold was delivering extraordinary returns, climbing from $3,000 to over $4,600, silver went from $28 to over $90. Gold investors made 67%. Incredible returns by any measure. Silver investors made 147%, nearly 2.2 times the return of gold. And we're just getting started. What I'm about to show you next is the thing that took the entire market by surprise, and it's the reason this trend is nowhere near finished. On January 1st, 2026, China implemented new export controls on silver that fundamentally changed the global supply equation. This wasn't a tariff. This wasn't a quota adjustment. This was China reclassifying silver from an ordinary industrial commodity to a strategic material, placing it under the same regulatory framework they use for rare earth elements. Let that sink in for a moment. The country that refines 60 to 70% of the world's silver supply just declared that silver is now a matter of national security. Under the new system, only 44 state-approved companies can export silver. The requirements are brutal. You need to produce at least 80 tons annually. You need to prove consistent export records from 2022 through 2024. And even if you qualify, every single export now requires individual government licensing. The old quota system that had governed Chinese silver exports for 25 years? Gone. Replaced overnight with a discretionary approval process that gives Beijing complete control over when, how much, and to whom silver gets sold. Elon Musk saw the implications immediately. On X, he posted a warning that went viral within hours. This is not good. Silver is needed in many industrial processes. He understood what most investors didn't. This wasn't just China protecting a commodity. This was China ring-fencing critical infrastructure for their energy transition, their electronics manufacturing, their military applications. State-run securities times made it explicit in their coverage. Silver has been formally elevated from ordinary commodity to strategic material. Translation: China is keeping their silver for China. The market response was immediate, and it revealed something shocking about the state of physical supply. In Dubai, physical silver started trading at $99.93 per ounce. At the same time, COMEX futures in New York were quoting $72.26. That's a 38% premium for actual metal you can hold in your hand versus a paper contract promising future delivery. That gap isn't a pricing inefficiency, it's a bifurcation. It's the market screaming that paper silver and physical silver are no longer the same thing. Now, here's where it gets really interesting. Because China's export controls aren't happening in a vacuum, they're landing on top of a supply deficit that's been building for 5 consecutive years. The Silver Institute published their 2025 World Silver Survey, and the numbers are stark. Global silver demand in 2025 hit 1.24 billion ounces. Total supply, including both mining and recycling, came in at 1.01 billion ounces. That's a 230 million ounce annual deficit. To put that in perspective, Mexico is the world's largest silver producer. They mine about 240 million ounces per year. The 2025 deficit was equivalent to Mexico's entire annual production simply vanishing from the market. But here's what makes this crisis unprecedented. This isn't a one-year anomaly. 2021 deficit. 2022 deficit. 2023 deficit. 2024 deficit. 2025 deficit. 5 consecutive years where the world consumed more silver than it produced. Add it all up, and the cumulative deficit from 2021 through 2025 approaches 820 million ounces. That's nearly an entire year of global mine output that simply no longer exists in above-ground stockpiles. It's gone. Consumed. Turned into solar panels and circuit boards and 5G infrastructure and electric vehicle components that will never be recycled. And before you say, well, can't miners just produce more? That's the trap right there. Because silver isn't like gold. 72% of silver production is a byproduct of mining other metals, primarily copper, zinc, and lead. That means silver supply is determined by copper demand, not silver prices. A copper mine doesn't increase production because silver hit $90 per ounce. They increase production when copper demand justifies it. Even at these elevated silver prices, the supply response is minimal because the mining economics are driven by the primary metal, not the byproduct. New primary silver mines take 8 to 12 years to develop from discovery to production. Ore grades are declining globally. The easy deposits were found decades ago. What's left requires more energy, more processing, more capital investment for lower yields. CME Group published research showing that even with prices at current levels, the supply deficit will persist through at least 2027 because there's simply no way to bring enough new production online fast enough. Meanwhile, demand is exploding in ways that are completely inflexible. BMO projects that solar panel manufacturing alone will consume 261 million ounces of silver in 2026. In 2015, solar used 54 million ounces. That's a nearly 5x increase in just 11 years, and the growth curve is accelerating. Every electric vehicle requires approximately 2 ounces of silver for its electrical systems. Global EV production is projected to hit 20 million units in 2026. That's another 40 million ounces of annual demand that didn't exist a decade ago. University of New South Wales researchers published a study that should terrify anyone thinking silver prices will come back down. They calculated that if current solar growth trajectories continue, solar panel production will require 85 to 98% of current identified global silver reserves by 2050, not annual production. Reserves. The total amount of silver we know exists in the ground that's economically viable to extract. In other words, there isn't enough silver on Earth to support the energy transition at current consumption rates without prices rising high enough to either destroy demand or incentivize massive recycling infrastructure that doesn't exist yet. If you've made it this far, you're already ahead of 90% of investors who still think silver is just cheaper gold. But don't stop now, because what I'm about to show you is why gold's surge past $4,600 is actually the catalyst that sends silver into the stratosphere. On January 11th, 2026, Federal Reserve Chair Jerome Powell did something unprecedented. He released a public video statement addressing Department of Justice subpoenas that had been issued to him personally. The official reason for the investigation? Alleged irregularities in a $2.5 billion Federal Reserve headquarters renovation project. But Powell didn't mince words about what he believed was really happening. He called the investigation pretextual retaliation for setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. Let's be clear about what that means. The sitting Federal Reserve Chair just publicly stated that the executive branch is using law enforcement to pressure the central bank on monetary policy. This isn't speculation. This isn't conspiracy theory. This is the head of the Fed saying out loud that the independence of the United States central banking system is under direct threat. Deutsche Bank saw this coming. In July of 2025, they published a warning that made headlines. Both the currency and the bond market can collapse if Fed independence is compromised. Because here's what most people don't understand about monetary systems. They run on confidence. Not gold backing, not legal tender laws, but the collective belief that the currency has stable value and that the institution managing it acts in the public interest rather than political interest. When that confidence cracks, capital flees, not slowly, fast. Gold has become the primary beneficiary of this crisis. Central banks around the world are watching what's happening in the United States, and they're drawing conclusions. For 3 consecutive years prior to 2026, central banks purchased over 1,000 tons of gold annually. That was already a historic buying spree. JPMorgan Global Research now projects that central banks will add another 755 tons in 2026, with the buying concentrated among nations explicitly seeking to reduce dollar exposure. HSBC is forecasting $5,000 per ounce for gold by mid-2026. JPMorgan has a $5,500 to $6,000 target. These aren't fringe analysts. These are the largest banks in the world saying that gold is repricing based on a fundamental loss of confidence in dollar-based monetary architecture. But here's what makes silver different, and this is critical. Gold is the monetary metal. Central banks buy it. Billionaires buy it. It's the ultimate store of value in a crisis. Silver is the monetary metal and the industrial metal. It has all the monetary premium that gold has when confidence collapses, plus it has the structural supply deficit driven by technology and energy transition. That dual demand is why the gold-to-silver ratio is compressing so violently. Think about the mechanics of the ratio trade. At 1:7 to 1, an investor could trade 1 ounce of gold for 107 ounces of silver. At 50 to 1 today, that same gold ounce gets you 50 ounces of silver. The ratio compressed by 57 ounces. Historical averages over the past century suggest the ratio should sit around 60 to 75 to 1. In ancient civilizations, the ratio was often fixed by law at 12 to 15 to 1 because that roughly reflected the relative abundance of the metals in the Earth's crust. We're not going back to 12 to 1. But Mike Maloney from Gold Silver has run the numbers on what happens if the ratio reverts to 33 to 35 to 1, which would reflect historical normal when above-ground stockpiles actually existed and buffered supply shocks. At those levels, silver would outperform gold by 6x from current prices, even while gold itself is soaring past $5,000. Rick Rule, one of the most respected resource investors in the world, bought massive positions in silver when it was trading at $25 to $30. He just publicly stated that he's now selling above $90 because my thesis has occurred. But even Rick Rule acknowledges that the structural case suggests this might be early innings, not late. Because the thesis wasn't just mean reversion on the ratio. The thesis was a supply deficit meeting, an industrial demand explosion meeting, a monetary crisis. All three are intensifying, not resolving. Now let me show you what's happening in the actual physical market, because this is where the crisis becomes undeniable. In October of 2025, a $100 million order for physical silver from India hit the London market. This should have been routine. London is the center of global precious metals trading. $100 million is large, but not unprecedented. The order triggered immediate market seizure. Silver lease rates, which measure the cost to borrow physical metal, spiked from 0.25% to 200% overnight, an 800x increase. Swiss refiner Metalor, one of the largest precious metals refiners in the world, announced they were withdrawing from silver delivery commitments until January 2026. The market didn't just tighten, it froze. The United States Mint suspended sales of silver products, not because demand was low, because they couldn't source enough silver to meet orders. COMEX, the primary futures exchange for silver in North America, reported registered inventory of just 127 million ounces available for immediate delivery. Meanwhile, the open interest, the number of contracts representing claims on silver, sits at over 45,000 contracts. Each contract is 5,000 ounces. That's 225 million ounces of paper claims on 127 million ounces of physical metal, a ratio of 177 to 1. And it's getting worse, not better. January 7, 2026 data showed something remarkable. JPMorgan issued 99% of the 8.1 million ounces delivered against COMEX contracts that day. One bank, 99% of deliveries, and open interest is still increasing, meaning more claims are being created on a shrinking pool of physical metal. David Jensen, an analyst tracking the London silver market, put it bluntly, given the billions of ounces scale of London's silver problem, this may escalate quickly. He's not talking about a squeeze that plays out over years. He's talking about a potential market break where the paper price becomes completely disconnected from physical availability. We're already seeing it in regional markets. Dubai at $99, while COMEX quotes 72. That's not arbitrage. That's market failure. Because if you could actually get physical silver at COMEX prices and ship it to Dubai for a 38% profit, every arbitrageur on the planet would be doing it. The fact that the gap persists tells you that COMEX physical delivery is either unavailable or so constrained that the trade doesn't work. Now let me tie all of this together, because when you see how these pieces connect, everything changes. Gold remains the ultimate monetary hedge. There's no question about that. Central banks will continue buying. JPMorgan projects 755 tons of central bank demand in 2026. With Fed independence under threat, with geopolitical fragmentation accelerating, with $43 trillion in global debt requiring ever lower real interest rates to remain serviceable, gold has a clear path to $5,000, potentially $6,000 per ounce. If you own gold, you're positioned correctly for monetary chaos. You're holding the asset that has preserved wealth through every currency crisis in human history. But silver represents something different. Silver is the asymmetric trade. It has all the monetary properties of gold, all the safe haven characteristics, all the crisis hedge appeal, plus it has the industrial demand explosion driven by energy transition and technology that cannot be solved without dramatically higher prices or demand destruction. Bank of America's Michael Widmer has a base case target of $135 per ounce for silver, with upside scenarios reaching $309 if supply constraints worsen or monetary stress intensifies. Citigroup is projecting $100 by March 2026, just 2 months away. These aren't wild speculations. These are major bank research departments looking at supply deficit data, industrial demand forecasts, and monetary conditions, then running the math. Here's the psychology that makes this work. Gold investors buy for safety. They want to preserve capital. They accept single-digit or low double-digit returns as the price of security in uncertain times. Silver investors who understand the dual nature of the metal, who see both the monetary and industrial case, are positioned for potential triple-digit percentage returns, because the market is still pricing silver primarily as an industrial commodity when it should be pricing it as a strategic material in structural deficit during a monetary crisis. The gold to silver ratio at 50 to 1 today versus 107 to 1 9 months ago tells you the repricing has started. Historical context says it has much further to run. In 1980, during the last great precious metals bull market, the ratio briefly touched 15 to 1. We're not predicting 15 to 1. That was a different era with different supply dynamics. But a move from 50 to 1 today to 35 to 1, which would simply reflect pre-deficit historical norms, would mean silver outperforms gold by 43% from current levels even if gold doesn't move at all. If gold goes to $5,000 as the major banks project, and the ratio goes to 35 to 1, silver would be at $142 per ounce. If gold reaches $6,000 and the ratio hits 30 to 1, silver would be at $200 per ounce. Those aren't fantasies. Those are arithmetic outcomes of conditions that already exist. China has already ring-fenced their silver supply. The structural deficit has already depleted above-ground stockpiles. The Federal Reserve independence crisis has already triggered gold's run past 4,600. Solar demand is already consuming over 200 million ounces annually and growing. The physical market has already divorced from paper prices. These aren't predictions. These are current realities that haven't fully expressed themselves in price yet. Almost there. But before I wrap up, I need to show you how all of this works together as a system rather than isolated facts. The reason this matters is timing. Gold has already run. It's up 67%. It's making new all-time highs regularly. Investors who bought gold at $2,500 did well. Investors who buy gold at $4,600 are still buying insurance, still buying safety, but they're buying after a major move. Silver at $90 is up massively from $28, but it's still undervalued relative to gold on a historical basis, still undervalued relative to its cost of production, still undervalued relative to its industrial scarcity. The best risk-reward in precious metals right now isn't in the asset that's already tripled. It's in the asset that's doubled but has structural reasons to double again. There's a concept in markets called path dependence. Small early advantages compound into massive later divergences. Silver's industrial demand creates persistent buying that gold doesn't have. A central bank can decide to pause gold purchases. They did it in the 1980s and 90s. But solar manufacturers can't decide to pause silver consumption without shutting down production. Electric vehicle makers can't substitute away from silver without redesigning their electrical systems. That demand is sticky in a way that monetary demand isn't, and it creates a floor under prices that prevents the kind of multi-decade bear markets gold experienced from 1980 to 2000. The path we're on leads to one of two outcomes. Either silver prices rise high enough to destroy industrial demand, forcing manufacturers to spend billions developing substitutes and redesigning products, or silver prices rise high enough to make previously uneconomic deposits worth mining and to incentivize large-scale recycling infrastructure that doesn't exist today. Both outcomes require substantially higher prices than $90 per ounce. The Silver Institute estimates that recycling infrastructure capable of recovering silver from electronics and solar panels at scale would require prices above $150 sustained for several years to justify the capital investment. New primary silver mine development requires even higher price assumptions over longer time frames. In other words, the market is telling you something right now. $90 silver isn't solving the supply deficit. It's not bringing enough new supply online. It's not destroying enough demand. It's not building recycling capacity. Which means $90 is a waypoint, not a destination. The destination is wherever price needs to go to actually balance supply and demand. Based on the structural factors we've covered, that number is substantially higher than where we are today. Your future self, looking back at 2026 from 2030, will either remember this as the year you positioned yourself in the greatest precious metals trade of the decade, or the year you watched it happen while sitting on the sidelines. Gold is safety. Gold is security. Gold belongs in every portfolio as the ultimate insurance policy. But silver is the trade. Silver is the asymmetry. Silver is where the structural forces of this decade converge into a supply deficit that cannot be solved without a price that makes today's $90 look cheap. So here's what I want to know from you. Silver, gold, the Fed, inflation, China's resource strategy, the energy transition. What's the next topic you want me to dig into? Drop it in the comments, because I don't just make videos. I answer the questions that keep you up at night. The questions your financial advisor can't answer because they're selling products instead of providing analysis. The 800 million ounce deficit isn't coming back. China's export restrictions aren't getting reversed. The Fed independence crisis isn't resolving itself. And the ratio compression from 107 to 1 down to 50 to 1 in 9 months isn't a fluke. It's a message. The market is telling you that silver and gold aren't the same trade anymore. One is insurance. One is opportunity. You need to decide which one you need more.